Welcome to today's Explainer, where we're going to break down the exact mathematical and psychological path to take you from just saving your money to actually investing it, all without risking your financial security. Picture this for a second. You finally buckle down, you do the responsible thing, and you start saving every single month. You move a little bit over to your savings account, $100 here, $200 there, and it feels great. You feel disciplined, you feel financially mature. But then you inevitably hit this wall and you start wondering if maybe you're doing this whole wealth building thing wrong. Well, today we're going to fix that. Okay, let's dive into our roadmap for today. We're going to cover 5 key areas: the problem with saving, the actual math behind investing, the psychology of risk, our 5-step path, and finally, how to survive market crashes. This is completely designed to take the anxiety out of growing your wealth. Starting with Section 1, the problem with saving and why discipline alone just isn't enough. Look, building a savings habit feels super responsible, absolutely. But saving alone is almost never going to make you wealthy. It's totally crucial, sure, but it's not the finish line. It's literally just the very first stage. Imagine this sheer frustration of opening your banking app one day and you realize you've managed to build up a really fantastic $10,000 sitting right there in your savings. Incredible, right? But then you look at the interest. At typical rates, after 12 whole months of letting that massive amount of money just sit there, you've made like $50. $50. Meanwhile, you keep hearing everyone else talk about index funds and compound growth, and you just get this nagging feeling that you're missing a massive piece of the puzzle. Well, the crucial point here is understanding that your money actually has 2 completely different jobs. You've got protection and you've got growth. Your savings account, that is your shield. It protects your money. But you absolutely need investments. Think of that as the plant to actually grow it over time. If you try to force your safety net to do the heavy lifting of growing your wealth, you're just going to end up frustrated. Let's move into Section 2 and look at the actual math of investing to really understand this wealth gap. The difference here is honestly staggering. Let's say you take that $10,000 and leave it at a 1% savings rate. Over 20 years, you end up with about $12,200. But if you take that exact same starting money and get historical 10% stock market returns, that rockets up to roughly $67,000. It's the exact same seed money, but a completely different financial reality. And it gets even crazier when you look at consistent investing. Say you just put in $300 a month over 25 years, your total out-of-pocket contribution is $90,000. But thanks to the absolute magic of compounding doing the work for you, your final balance blossoms to nearly $285,000. Almost $195,000 of that came purely from investment growth. That's the math working for you. So, moving to Section 3, the psychology of risk. If the math is so incredibly clear, why do so few people actually make the leap? Well, it all comes down to psychology. Saving feels safe, You can see it, and it doesn't randomly drop 5% on a Tuesday afternoon. Investing, on the other hand, feels risky because it fluctuates. It's kind of like seeds in a jar. Keeping your money in savings is like storing seeds in a glass jar on your shelf. They are perfectly protected, but absolutely nothing is ever going to grow in there. Investing is taking those seeds and burying them in the dirt. It looks messy at first, and you don't see results immediately, but it's literally the only way to grow a tree. The hard truth is, staying safely in the jar means missing out on the most significant wealth gap that exists today. The real divide isn't between the people who save and the people who spend. It's actually between the people who save and the people who invest. To prevent that fear of the unknown from completely paralyzing you, this transition shouldn't happen all at once. Let's look at Section 4, our 5-step path, which is a low-stress roadmap to wealth. Okay, let's break down this super practical framework. Step 1, before anything else, is building a 3 to 6 month emergency fund in cash. This is absolutely crucial because it acts as a firewall. It protects your future investments so you never have to panic sell them just to fix a broken transmission. Once that's in place, you can ease into the rest. Mentally separating your money, starting really small with maybe $50 or $100, keeping your investments simple, and staying disciplined. Now, Step 2, creating mental buckets, is a massive psychological hack. You have your safety money, which is your emergency fund, and that never moves. Then, you have your growth money, which are your investments, and you explicitly give that money permission to fluctuate over time. Separating these completely changes how you view a red day in the market because you know your safety net is totally fine. And when it comes to step 4, actually picking your investments, skip the super complicated day trading and the crypto speculation. Seriously. Focus on really boring but highly effective tools like index funds. Basically, these just track the overall stock market. Instead of trying to guess which single company is going to win, you're holding tiny pieces of hundreds of companies all at once. It's incredibly simple, it diversifies your money, lowers your risk, and provides steady long-term growth. I mean, even legendary investor Warren Buffett constantly champions this exact boring approach. It just proves that the absolute most powerful investing strategy isn't about outsmarting everybody else on Wall Street. It's about simple, low-cost consistency. Finally, let's move to Section 5, Surviving Market Crashes. This tackles the ultimate psychological hurdle for most people, the terrifying idea of actually losing your money. What if I start investing right now and tomorrow the market crashes? It is a totally fair question. Market crashes are completely normal, and they have happened dozens of times throughout history. The markets go down, the news headlines scream that the sky is falling, and people panic. But this is exactly the moment where discipline separates the actual investors from the gamblers. If you just remain disciplined, a market crash isn't a disaster at all. It's honestly a massive clearance sale. Think about it. If you're putting in a set amount every month, a drop in the market means you are automatically buying more shares at heavily discounted prices. You accumulate all those cheap shares, which leads to incredibly strong returns when the market inevitably recovers. Experienced investors stay perfectly calm because they're thinking in decades, not days. Ultimately, combining the saving discipline you've already mastered with this new investing knowledge is what totally unlocks your financial future. Saving money gives you that required stability, but investing? Investing gives you true freedom. It buys back your time. The earlier you combine both of these, the more unstoppable your future becomes. So as we wrap up this explainer, I want you to look at your own finances and ask yourself a really vital question. Are you currently protecting your seeds in a glass jar, or have you already started planting them in the soil? The most important dollar you will ever invest is your first one. So take that leap, look into your first index fund and ask yourself, what could your net worth actually look like a decade from now if you planted that seed today?